Hi, I'm Miranda Carr, Chief Investment Officer at the Trust Company of Tennessee, and I'm going to be covering what happened in the economy and the market in the last quarter of 2025. It was a positive end to a positive year across asset classes. The Fed cut rates twice during the quarter, which boosted stock and bond prices. Companies reported strong earnings growth, which was also supportive of stock prices. And while we didn't get much of the economic data on time, and some not at all, due to the extended government shutdown, the data that did print was seen as mostly positive. Looking abroad to Europe and emerging markets, we saw positive earnings, which led to international market outperformance relative to the US. One of the main themes in 2025 was a softening dollar, and for several years, economists and market analysts have been predicting a fall in the dollar, merely due to an unsustainable rise in the dollar in previous years. So many have been looking for this trend to reverse, pointing out that the dollar was overvalued and predicting that it would come in a bit, which it did. The strength of the dollar in prior years did contribute to underperformance of international stocks to US investors. And conversely, the fall of the dollar in 2025 contributed to additional gains to US investors in international markets. Real assets had mixed results for the quarter and the year. Rates are very sensitive to interest rate changes, and while the short term rates came down, the back of the curve, those long dated treasury yields, did not fall during the year, which muted REIT returns. Prices across most of the commodity complex were down, but uncertainty and fears of inflation drove up the price of precious metals. So gold and silver did tremendously well over the quarter and during the year. The economy did have positive growth in 2025, despite all of the policy shifts we saw around tariffs and taxes and geopolitical headlines. It was a very busy year for market watchers regarding all of the news that broke. We did see the unemployment rate creep up steadily over the year, which turned the Fed's focus from containing inflation to trying to support the labor market. And unfortunately, inflation did come in higher than expected in 2025. And now, with a more dovish Fed expected, inflation will likely run hotter than the Fed's target. This is really one of the first times we saw a cycle where the Fed was cutting rates at the same time they were increasing their forecast for inflation. So, definitely a different situation than we've seen in the past. And if we look at a rate of inflation of 2.5 or 2.6%, that is a pretty big difference over their target of 2%. So, compounded over time, that's a pretty significant rise in price levels. Having said that, the outlook for the economy this year is positive. No one is forecasting a recession, and more importantly, the earnings outlook is positive. The chart on the top right shows a breakdown of equity returns for 2025 compared to the last 15-year average. So equity returns are made up of a few key drivers. Dividends, of course, are a small component of return in the short term. Currency translation for investors in international assets can contribute either positively or negatively, although over the long run, it's usually a wash. And then prices go up either because a company is growing its earnings or because investors are just willing to pay a higher price today for a dollar of future earnings, and that's called multiple expansion. After many years of dollar strength, we saw a reversal in the dollar, which provided a currency benefit to the returns for international investments. But we also saw a price rise in multiples. So the price rose faster than the earnings rose. However, expectations for future earnings went up across the globe, which is why we saw a bit of a reset in Europe, with multiples coming up closer to long term averages. And 2026 is expected to be another good year for earnings. Since 1950, the correlation of the S&P 500 earnings with S&P 500 price movement is 0.98. So very significant. Growth in earnings bodes well for growth in the market. Not a guarantee, of course, anything can happen, but the outlook is very positive. Much of that earnings will come from the Magnificent Seven, so those top 7 technology stocks in the S&P 500. But the good news is that some of the gains from AI are also expected to begin to flow to other large companies as they see some of those early productivity gains. So the consensus view is for a broadening out of earnings and performance from the rest of the S&P 500. You can see on the bottom left that the return share to the index from those 7 companies has been drifting lower, now below 50%. And on the bottom right, you can see the earnings growth from the Mag 7 is still expected to be strong in 2026, but the growth rate for the rest of the companies in the index is expected to accelerate this year. All sectors of the S&P 500 had positive returns for the year, but you can see the dispersion between sectors, with communications sector up 34% for the year, and then consumer staples, for example, up only 4%. From a style perspective, value outperformed growth for the quarter, which was magnified in international developed markets, since some of those markets tend to have a more value-oriented market than we do. And then we have highlighted the difference in some of those emerging market countries, with China being down 7% for the quarter and South Korea up 27%. So this just illustrates the importance of having an active manager that can use their judgment, not own the whole index the whole time, and just use their information advantage to drive outperformance. Fixed income is in a pretty good spot. The overall fixed income market was up about 7% last year, and the yield on investment grade debt is still above 4%. It's closer to 5% actually, which makes for a nice return even without price appreciation. Yields are expected to come down a bit this year. The futures market is pricing in 2 Fed cuts this year, which are expected in the second half of the year, so bonds may see yields fall and prices rise a bit as well. Real assets have garnered a lot of attention this year, particularly precious metals. And the interesting thing to me is that gold is usually a flight to safety asset, meaning people buy it when they're feeling fearful, when there's a lot of uncertainty or concerned about the future, concerned about inflation. Gold has seen some continued international buyers in other markets where either their central bank has been buying for reserve purposes, or citizens of countries with less stable governments or more authoritarian governments with strict capital controls have been buying. But gold is not an asset that we typically have direct exposure to because it is a very risky asset. It's really more of a speculative play. It doesn't have a yield or a dividend. It's not a company that has cash flows that's producing something valuable. So it isn't intrinsically valuable. It has not been a good hedge against inflation over the past 40 or 50 years either. Just a few months ago, gold finally reached its prior inflation adjusted high. Stocks and bonds have had much higher returns than gold over the prior few decades, even with the astounding run in 2025. And just as quickly as people bought it, they can sell it when sentiment turns. Over the last 50 years, if you had bought gold at a previous peak, you could have seen a loss of as much as 63%. So it's certainly not a good long-term store of value relative to other assets you could own. We have a good amount of research on gold, so if you're interested, please reach out to us. Additionally, we like to buy things that are priced below their long-term value. So REITs are one area that did not have a big run-up in 2025. And they're an interesting asset class because they respond to both interest rates and the outlook for economic growth. And you can see within the REIT asset class, this isn't just residential real estate or commercial space. It's a very diversified asset class. So it also has a good outlook for 2026, even though it was up only positively during 2025. And one last thought that I will leave you with is the importance of staying invested. 2025 had a lot of surprises, and no doubt 2026 will too. But regardless of what you see in the news or even in your account on a bad day, if you have a long enough time horizon, there is no reason for you to make big changes to your portfolio based on the headlines or even based on big swings in the market. This chart shows that going back to 1989, if you had invested in an all-stock portfolio, you would have had positive returns over any period most of the time. And over any 10-year period in that time frame, 93% of the time would have been positive. We did have the unfortunate 10-year span that encompassed the tech bust as well as the financial crisis. So that was a rough stretch for investors. But even if you go out another year or two for 11 or 12 years, a huge market rally after those dips helped all of those investors who did not panic recoup their investment. But even if you were a bit more cautious, maybe you were closer to retirement or just risk averse, and you invested in a portfolio that had 60% in stocks and 40% in bonds, 100% of the time over a 10-year period, you would have been positive, and close to that over even a 5-year period. So stocks historically have been the best hedge against inflation. Bonds historically have done well during times of economic weakness. And if you want to grow your wealth, you have to stay invested. Otherwise, you are losing to inflation. I also want to mention that individual companies do go bankrupt. And even if they don't, individual stocks can often give you a negative return. But if you're in a diversified portfolio with lots of different stocks and bonds, that's when you experience what's on this chart. So if you have any questions or you want to chat with us further, please reach out to your relationship manager.